With Prashant Khemka, who's founder at White Oak Capital Management, joins us right here in our studios this special Friday to talk about the markets and the outlook thereof. Prashant, it's great to have you in the show. Thanks very much for stopping by.
Pleasure to be here.
Welcome to our studios.
Pleasure to be here.
How are you reading the markets? Very simply.
So markets are as usual. I think every time over the last many years, one feels that the markets are particularly volatile at this time, but there's been no other time that it has been less volatile. So they're no different in that sense. It's markets as usual. Yes, there are certain events over the next 6 months which only come once in 5 years.
Yeah.
So markets
no, but when you say it's
those.
markets as usual, you know, Nikunj, who was here a little while back, we were discussing how this year, from an asset class perspective, has been a no-show for the markets. You've not seen a particular asset class, whether it's on domestic turf, whether it's in world markets, bonds, equities, commodities that have shown returns. So from an investor standpoint, could I say 2018 has been disappointing? Maybe there's something more to look at optimistically for next year, but this year, in that sense.
So see, over time, over longer time, equity markets, for example, in India, if you look at a 30-year window, have returned about 14 to 15%, and they've not come in a straight line, 14% a year. Certain years we've been down a lot, 40, 50 or more, and certain years we've been up as much as close to 100%. So that's the nature of the market, and this year is a more flattish year. Though there has been excitement in the mid and small cap space, they're down a lot, and the large caps have held up flattish to slightly up. In India, and you're right, globally also. So it is one of those years where you haven't done too poorly, is the way to look at.
Yeah, it could have been a lot worse. But as we now are just a month away from closing in on the year and just looking forward to what 2019 could be, throw up at us, a lot of uncertainties behind us. The Nifty is now back at 10,900 as we speak right now. You've got crude, which is now jumped up to a one-year low, or rather cooled off to a one-year low. Rupee has strengthened now to a 9-month high. Would you say that a lot of the uncertainty is already baked into the price, or because of just so many events lined up, everything from the G20 meet to the OPEC meet to the Brexit vote, our own state elections, and then the 2019 elections, you would say that, you know, this is a sticky spot. You don't know how long the market is going to sustain here.
So again, as I said, these events, particularly like G20 and all these, continue in the backdrop all the time. What's most pertinent for India is the corporate earnings growth, which is picking up momentum over the last few quarters, as clear signs of the long-awaited earnings growth pick up from single digits to at least in the teens. Yes, the next 6 months with the elections, central elections in May, and also in a couple of weeks the outcome of assembly elections, there could be a little more volatility, and it is subject to what kind of outcomes we get in the elections.
But in such a scenario, Prashant, how does one go about stock picking? How is it that you certain value? You made the point that earnings growth is picking up, and typically, investors in the realms of being realistic would want to map their returns to what the earnings look like. So on that parameter, where do you think the risk-adjusted reward opportunity lies in the market?
See, stock picking isn't much affected by these events, if you will. I don't think our team is doing anything differently currently than what they've done over the years, and over any particular point in time, I don't think from a stock picking perspective you do any differently. Again, depends on your style of investing as well. But you continue to look for good businesses, or as we call great businesses, which are attractively valued. And those businesses occur in every environment. Volatile environments may give even more opportunities, but typically they are, since environment is always volatile, you have those opportunities all the time. So I don't think that from a stock picking perspective you can change anything event to event. Otherwise it will just result in, and then there are styles which follow that, but I think it's certainly not our style. I think there are better ways of generating higher returns. Otherwise, you just generate a lot of turnover without generating much return. So the fact that there are these events lined up hasn't changed.
Are you buying in mid caps?
Yes, as always, we are across the market cap segments, large, mid, small, across various sectors. Yes, the team has a certain investment philosophy and process that leads to certain sectors presenting larger number of opportunities, and yet other sectors presenting fewer opportunities. And that is more of a structural, has been structural in nature, not dependent on
Market
specific events.
Fine. Since you're market cap agnostic, where is it that you find those opportunities? Because, you know, many believe that the next 6 months is going to be volatile, it's going to really test your patience, but this is the time to do your homework, portfolio build, because the year after that, maybe it could be blue sky zones, maybe the Nifty could be sitting at a fresh high, and things could be a lot different across the world. Where do you find those alpha opportunities?
So the alpha opportunities are across spectrum, certainly around the world, not just in India,
Sure. But let's start with India first.
Certainly. No, like I was saying, developed markets or emerging markets, there are greater inefficiencies in mid caps and small caps. There are certainly opportunities you find in large caps as well, but just the sheer number of stocks in mid and small caps are much larger, and they are by nature, by definition, everywhere under-researched. So there are greater number of inefficiently priced, attractive businesses in the mid and small cap range. So we do find a lot of opportunities in mid and small cap, and also opportunities in large caps. But as I said, there are fewer, so you take chunkier positions in large caps, and the liquidity and market cap also allows for chunkier positions.
Yes.
In mid and small caps, there are a large number of opportunities, so you don't need to take chunkier positions. You can take larger number of positions. And in terms of sectors, I think it's easier to highlight sectors where we have historically or structurally tended to have greater difficulty in finding great opportunities. Just because what our philosophy is, focus on superior returns on invested capital, scalability, and well-managed companies, both in terms of execution and governance. So we've historically struggled to find opportunities in the energy sector, in telecoms, in utilities. At this time, are not able to find opportunities in real estate, either in metals. Generally, we don't have much investments in government-owned equities, and that is the case right now as well.
With banks too?
Government-owned banks, yeah, generally hardly ever invested in government-owned banks, be it in India or when I was managing global emerging markets. Because these are, I think of government-owned entities as a bit of a separate asset class altogether. Just like you have fixed income, commodities, private equity, and public equities, while they are clubbed together, tend to think of them as a different asset class. There are privately owned public equities and there are government-owned public equities, and they're quite different, and I've usually struggled to find the kind of philosophy we have, struggle to find attractive opportunities in government-owned entities.
So you've told us what you're staying away from, but that leaves two large pools, which I guess you would be keen on. That's financials and consumption. Now again, within consumption and financials, considering there's such large pools, news flow is heavy, we've all seen how Q2 has been a little tepid, lackluster. Within that, where are you taking concentrated bets?
Certain. So there are several sectors, obviously you highlighted consumption and consumer and financials too, but also technology, also healthcare, and you know, you have industrials more broadly. So all these sectors are well represented in the portfolio. And in financials, if you were to, you know, in particular talk about, we find historically have always found a lot of opportunities in private banks, well-run private banks. Asset quality is of highest focus for us in investing in financials, because when you look at 3 times price to book versus 1 time price to book, I think that's a very misleading comparison. because the debt is a given. You have to pay back the debt, and these banks are leveraged 10 times to equity. So if you look at assets are what you're buying. So when you look at a high quality asset bank which is trading at 3 times book, you can also look at it's trading at 1.3 times assets, compared to a bank that's trading at 1 time book, which may be trading at 1 time or 1.1 times.
So you're staying with
assets.
the compounders, I'm guessing.
So certainly if you position this way, 1.3 times for these well-run banks is a lot cheaper or very attractively valued than 1 time for some of these corporate lenders where you don't know what's in the asset side.
You really don't know with the corporate lenders right now as well? I mean, let's start spelling names for the benefit of our viewers.
So I can't.
Yeah,
I can't.
You can't. But I'm just trying to build a case over here that, you know, purely because I know that the HDFC banks, Kotak banks, IndusInd banks of the world have done well. But then now, it's not just about what the compounders do in terms of giving you consistency in returns. It's about how much can you generate that outperformance on, the alpha, from the underperformers. What about leadership transition? What about transition in some of the corporate lenders where they're not only building their CASA book, not only retail, you know, they're kind of debalancing or de-risking their business models. Would you attribute that change in their business model and the change in their leadership as a positive to seek value in those businesses?
So very good point. I think the fact that a lot of the managements are in transition do offer a lot of opportunities. I think banking, there are certain sectors like banking and IT which are very execution-led businesses. There are certain businesses which are brand dependent, and a good management or a bad management can do only so much additional good or additional harm to them. But businesses like banking and IT are very, very execution dependent. And the problems that you see in banks, I'm leaving aside PSU banks, but in private, the banks where you see problems, those were execution driven problems or execution shortfall problems. And the banks, some of them you mentioned, and as I have said in the past as well, sooner or later India would have the largest bank by market capitalization in the world. Those are banks which have created value through sheer execution. So to the extent that management changes are happening, particularly in banks which were in the past not well managed, that does present an opportunity, and we look at very closely, and some of those we have used the opportunity, the recent fall off in the market, NBFC related, we've used that opportunity to add to those financials where the new managements, we believe, would execute well, and so their future would look very different to their past.
Okay, so there's a fair amount of confidence that's being infused.
Certainly.
I want to ask you about how, you know, one of my fund manager friends has said that never let a crisis go to waste. Do you think that the NBFCs, and I know this was not a full-blown crisis, but you're calling it a mini crisis, so to speak, because it came to a point when, you know, it was make or break. Are you sizing up opportunities within NBFCs and, you know, saying that, look, some of the high-quality names didn't deserve to fall as much as they have, and so if you had a position there, did you build on it? Or are you also, you know, being the brave heart and saying some of the bad businesses might be helped and, you know, they might be assisted in coming back to life, and so we should, on a selective basis, look at those opportunities?
So more of the former, because again, financials are heavily levered, right? So the price to book multiples mean you know, ultimately less. You know, so a 3 time going to 2 time is not as attractive as it may sound. Right? So, and typically in financials, given the leverage element, we have always been focused on superior asset quality, and many of those also came under pressure, both in NBFC, particularly in the NBFC space. And the team has used that opportunity to build to those positions. Just a little bit on the crisis, called it a mini crisis. Yes, it was a mini crisis. Now what's happened is very interesting since Lehman Brothers. Lehman is someone you only see once in a lifetime, in my view. It's like
it's like
a species of a flower that only blooms once in a certain 50 to 100 year time frame.
And you certainly can't call it. You know, my whole issue with a lot of these global managers saying 2019 is going to be disastrous is I'm like, nobody before 2007, 2008 ever saw the magnitude of the problem. So the very fact that they're calling for it reduces the chances of it happening.
Absolutely true. So the very fact that since 2008, everybody is running pillar to post looking for the next Lehman, the odds of the next, citing the next Lehman have gone down quite dramatically. But what it does do is, even when there is a small problem, it can blow it a little bit out of proportion because of the worries about.
You think that was the case with LNFS? Was it blown out of proportion?
Not
as much as reality?
I won't say any particular name necessarily. Sure. But yes, the scare of Lehman comes back to everyone when there is one skipped payment, which if Lehman had not occurred, might not, is still bad and very negative, no doubt. But the scare and crisis of confidence or lack of confidence can be magnified. Maybe rightly so, because you have to learn something from Lehman. But notwithstanding that, the fact that Lehman's so recent in our memory, I think you can never, I did say 50 to 100 years, but you can never rule out. But still the odds of next Lehman in our lifetime have gone down dramatically because of the Lehman we've already seen.
I hope.
You can never rule out.
To that. Okay. What about consumption then? Where are there opportunities?
So again, opportunities are across board. When we talk about consumption, we typically think of consumer staples and all. But consumption is a very broad category, including automobile.
Paints to everything.
And what's called consumer durables. I think we are finding more opportunities in that space. So travel and tourism related, entertainment related, and also the typical staples related. We are finding opportunities across board.
Very quickly before we close out the interview, I think just adding to what Ayesha was trying to derive from you is also consumption as a theme has never failed investors looking at India. The Indian consumers always given returns. The thing is, now we have a deal in the making, which is Horlicks, and who takes over the brand is going to be critical. But consumption always comes at a price, just like some of the high-priced private sector banks. You're saying, just because a bank comes at a price to book of 3-4 times does not make it expensive. You have to look at the relative ratios otherwise on asset and debt. What about consumer? Do you think that a price to earnings of 50 times or even 60 times as a multiple should not seem heady because there's growth visibility and that coming at a price is fair?
See, in my view and in my experience, PE multiples are the most useless and most abused way of, and so we have a very deep-rooted disregard for PE multiples as a means of valuation. My team members, I don't think, remember PE multiple current year or next year of any of the stocks in the portfolio, because there's no need to. PE multiples not just useless, but they're harmful, because you attach meaning to something that is meaningless. So ours is a lot more cash flow focused approach, and when you look at cash flow based valuation, some of these names are very attractively valued. Not everyone, I'm not suggesting that high PE means attractively valued, but that's not a metric you can rely on. I've been numerous number of times posed the question, why is China trading at more attractive multiple than India. The PE multiple. Because China often trades at half the PE multiple at times. That's comparing, or even Russia or EM in general, that is comparing apples to not oranges but apples to lemons at times. If you look, you have to look at the underlying constituents, the cash flow generation capability, the governance structure and composition of the index. Government ownership of Indian index is one of the lowest in emerging markets and one of the highest in China and Russia. So as I said earlier, there are two different asset classes. So if you separate the government owned or sovereign owned equities and privately owned equities and then compare the respective valuations, they would be a lot more similar. But you mix two different asset classes into one index and then comparing the composite, which is irrelevant, and the same is true for individual companies as well. You can't, one is very, Russia is 50+% commodities. You can't compare an Exxon multiple to a Pepsi or a Google multiple, which is what you'll end up effectively doing if you compare Russia. Leave aside the governance issues.
That's a valid point. In fact, we should try and do that for the Nifty. But great speaking with you, Prashant. This conversation could go on, but we're time bound, so we have to let you go on that note. Thanks so much.
Thank you, Ayesha. Thank you, Tanvir.
Thank you
Pleasure
very
to be
much.
here.
Thanks.
Thanks.